Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Bloomberg News is now reporting that the board has forced out Intel CEO Gelsinger. So definitely some concerns there at Intel as it tries to play catch-up on the AI game against the NVIDIAs of the world. Mandeep Singh joins us, Senior Technology Industry Analyst for Bloomberg Intelligence, joins us here in our Bloomberg Interactive Broker studio. So again, Mandeep, the reporting we're seeing out of Bloomberg News now is that it was kind of the board forcing out Mr. Gelsinger, and that kind of makes sense because, as you mentioned earlier, board concern, investor concern about the pace of which Intel was trying to, really become a bigger player in AI. What do you think's going on there in Intel?
Yeah, and the overall strategy for a turnaround like this. I mean, we know turnarounds are rare in tech. And in this case, I think the doubling down on the foundry side was a big mistake in hindsight. I would be very surprised if whoever they appoint, whether it's internal or external, really wants to focus on the foundry side as opposed to their core chip business, which is where they still generate bulk of their operating free cash flow. And when you look at the PC business, it's a $30 billion business, generates $10 billion in free cash flow, and it's still there. I mean, they're not gaining any share, but they're still the dominant force when it comes to the client PC desktop business. And I think that's the path to turn around this company.
Were you surprised by this, in that this happened before there was a successor actually announced, considering that meaning that, like, what's going to happen in the next, say, 2 months while they were looking for a successor that would have meant that Pat Gelsinger had to leave?
I mean, this reminds me a little bit about Microsoft, the way Steve Ballmer left and the way Satya Nadella was appointed. I wouldn't be surprised if one of the co-CEOs, Michelle Johnston, she ends up being elevated to the CEO role. But when I look at the turnaround prospects, I think this is a much harder turnaround than a Microsoft, simply because you've got a player in NVIDIA that's really taking share on the server side, and then TSMC on the foundry side. So on both the fronts, Intel is really losing share. The only front where they still have steady share is the client PC business, and that's why I think breaking up the company is probably the likely scenario here. I would be surprised if anyone tries to turn this around as is.
So, I mean, is this an attractive job for an external person? Let's say I'm a senior person at NVIDIA. I can get the big chair at Intel. Is that attractive?
It could be, but it sounds more like a PE playbook here, Look at the entity as a whole, figure out the strategic options, lever up. And look, the foundry business outside of Intel may actually end up doing well. And the reason I say that is right now, no one from an Amazon or a Microsoft or Google or NVIDIA wants to use Intel Foundry because they know Intel is a competitor on the chip design side. But once you take out the company and, it's an independent entity, everyone wants to have some onshore manufacturing of chips. That's what the government wants. So these companies may be forced, and with the incoming administration, I won't be surprised if they say, okay, you guys have to use some of the foundry options within the US. TSMC or Samsung don't have that kind of capacity that Intel has within the US.
So would the pitch be to spin off the foundry business kind of thing and then keep the PC chips and the AI chips?
Yeah, I mean, look, the foundry business is an $18 billion revenue business, although most of it is Intel outsourcing their business and counting as revenue. So it's not external foundry revenue, but it's negative gross margins. So the core PC business is about a 40 to 45% gross margin. The foundry business is negative gross margin. And they are spending $25 billion a year on CapEx just to buy the machines to keep up with the advancement in nodes.
Why do I have a business that has a negative gross margins?
Because it's like Intel is the vertical integrated player in chip design and manufacturing.
Okay, so it's all
so
part
they
of the
do
whole.
it all in-house. And for a while, that's why Intel's gross margins were the best, because they were doing everything in-house. But the moment they missed out on that node advancement where TSMC leapfrogged against them, that's when it all started to go wrong.
Amazing stuff. Yep. All right, Mandeep, thanks a lot. Really appreciate it. We'll clearly be talking to you every day on this for a while. Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst, joining us on Intel, and reportedly Pat Gelsinger being asked to leave by the board.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alongside Paul Sweeney, this is Bloomberg Intelligence Radio. We bring you all the top news, business, economic, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. All right, let's get to one of them right now. Supermicro Devices, Supermicro, I should say, up solidly. At some point, it was up like 30% today, up 22% now at this point. The Supermicro reviews finds no evidence of fraud, and the CFO was replaced. Let's get more on this. Jin Ho, a Bloomberg Intelligence Senior Technology Analyst, joins us now. Remind us what the problem is that Supermicro is trying to correct.
Yeah. Hey, Alex. Thanks for having me on. A couple of things. There was a short seller report back in August citing that there was some fraud, internally, and essentially because of that, there was an internal investigation, and they delayed their 10K and 10Q filings. And what Supermicro is essentially saying, their internal investigation has found nothing or no evidence of fraud. But the 10K and 10Q filings still have yet to be filed.
But it's not every day that a Big Four accounting firm does what happened here. Basically says, they really can't rely upon the management team, and they just walk away from an account. That doesn't happen very often.
No, Paul. I think between your lifetime and my lifetime in the financial industry, probably 4-5 times, right? So yeah, it doesn't happen. It doesn't happen. They did find an alternative, BDO USA, and quite frankly, with the special investigation, being completed without evidence of fraud, it actually almost gives them BDO a safety net to actually expedite the 10Q and 10K filing sign off, in my opinion.
So does this put all the questions to bed at this point?
No, not necessarily, quite frankly. I mean, let's see what BDO says. I do think they're going to try to push along the filings as quickly as possible, possibly by year end. The deadline is sometime in late February, but I do think they'll try to push it along. Now, I will tell you, the other question is that was there so much reputation damaged because of this? Did they lose business? And if you think about where the shares are today, it's still well off the peaks. Mm-hmm.
So, assuming they can put this issue behind them, what is the story for this company here, Supermicro News? How do you position it within your tech stocks?
Yeah, look, Supermicro has been one of the hottest companies within the hardware industry. They were on the forefront or the poster child of AI servers. And you've seen a rapid rise in sales going from $1 billion or $3 billion in annual sales, and they were on track to about $26 to $30 billion in annual sales in fiscal 2025, right? And this is over a span of 4 years. Now, they didn't retract guidance, but they didn't affirm guidance either. Mm-hmm. So the question is that, look, what is the real sales going into fiscal 25? We do have a scenario analysis that in a draconian way, it's going to be $16 billion in sales, right? That's far off of the 26 on the low end, but it's still $16 billion in sales that Supermicro could deliver on the AI story alone.
And this is AI hardware, right, versus AI chips, for example, from NVIDIA, right? So a competitor would be like Dell, right? Like an AI
Dell,
server play.
Exactly.
So if I was a customer and I was like, you know what, Supermicro, I need to go somewhere else, is the only other option Dell, or are there other players out there?
Oh yeah, look, if we go back to last May at NVIDIA's conference, there were a host of AI server companies that were willing to partner with with NVIDIA. So Supermicro is not the only game in town. Neither is Dell nor HPE. There are some Taiwanese ODMs that are more than happy to assemble AI servers out there. So we've seen because of the growing competitive pressure, we've seen margins compress as a result for the industry.
So they sacrifice, it feels like, the CFO here. How does the street feel about the rest of the management team, the leadership, as well as the board?
Well, look, the main issue in my mind was not only the CFO, but also the board. When you have the wife of the CEO as a member of the board and a 17-year-old a person on the board who's been on for about 17 years, there's very limited independence. Quite frankly, I do think there needs to be some sort of overhaul of the board. And I've said in the past on this show, and I have written that I think the CEO may need to be promoted to a chairman role and may need a new CEO.
Now, what part of all of this has to do with just going from a company in the Russell to the company in the S&P and just growing super fast and having different kind of analyst coverage? And how much of this was going to come kind of no matter what?
Yeah, that's a good question, Alex. Look, this used to be a Russell company or a mid-cap company, and it was under the radar for a lot of analysts. And now we're talking about being in the S&P 500 index, and you're going to have a lot of magnifying glasses on the financials. And keep in mind, it's only been about 5 to 6 years back where they were delisted from the NASDAQ, and for them to do this again, it's quite frankly shameful in my mind. Now, if there is no wrongdoing here, shame on me, right? But fool me once, shame on them. Fool me twice, shame on me. So, you're going to see a lot of scrutiny going forward. I don't know if they'll come back after this.
Have they lost customers to any material basis?
Nothing reported as of yet. What they said on the last earnings call was that there were a couple of customers who they're trying to retain.
That's a nice way of saying not yet. I think from a CEO speak. How much more? Okay, so just pure valuation perspective. How do we know how to value this company when there are all these questions?
Look, at the end of the day, and Paul taught me well. It's all about cash flow and earnings.
Nice job.
And I don't know what earnings is. In our scenario model, we have $1.60 in earnings going forward, and hardware companies of this ilk, AI companies, are ranging anywhere between 10 to 15 times. So if my $1.60 is right and it's going at around, let's just say at the high end, 15 to 16 times, it seems like from a valuation standpoint, it's trading at the fundamentals.
All right, Woo-Jin, thank you so much. We appreciate it. Jin Ho, Senior Technology Analyst for Bloomberg Intelligence, down there in Princeton, New Jersey. Supermicro, looks like they're trying to make some headway here. They let go their CFO, but it looks like they're going to get their accountants to sign off on some of their financial statements that'll allow them to file their Ks and Qs and maybe get some of this accounting issues behind them. Because as Woo-Jin was saying, before this accounting issue, there was a high-flying stock and really believed to be and discounted by the market as one of the plays for AI right here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get more on the manufacturing data, because for the first time in 8 months, new orders entered expansion territory. Joining us for now is Tim Fiore, chair of the Institute for Supply Management's Manufacturing Business Survey Committee, and he joins us now. Hey, Tim, what drove that expansion?
A couple things, Alex. First off, the new order number finally broke 50. I mean, we've broken 50 before in the last couple of years, but we've broken 50 here for a good reason. It feels like demand is starting to come back now that the uncertainty around the election is behind us. So that's a good thing. The other thing that validates that is that our manufacturing inventory number actually rose 5.5 points, which would also indicate that companies are more willing to invest in working capital to get ready for the 2025 business here. So overall, a good report. I think the other point here is our employment, although we're still destaffing, we're not destaffing as strongly. We came in at 48.1. So the three of those together got us close to 49. And I'll tell you, if the supplier delivery number, which surprisingly actually got faster, if it had remained slower, we would have broke 49 and gotten closer to 50. So overall, a good report for November, a little bit surprising, a little bit more positive than I would have thought this early, but very consistent with the fact that we're on a rate reduction cycle. The election is behind us. It's obviously going to be a positive thing for the economy. And off we go into 2025.
Tim, great to have you with us. Tim Fiore, chairman of the Manufacturing Business Survey for the Institute for Supply Management, zipping in here with some economic data for came in a little bit better than expected, so we'll take that. I wonder how much of that has to do with the election and some of the economic optimism that is felt in a lot of parts.
Well, and also, I wonder how that winds up looking as we go into 2025, because will we see stockpiling ahead of any tariffs as well, and will that change the inventory and new orders? That could be interesting to figure out, too.
Yep, very good.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alongside Paul Sweeney, this is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance and politics from our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. We also tap wonderful guests outside of Bloomberg Intelligence for their broader take on the market, particularly after a really stellar year. Here's some facts for you. S&P is up almost 27% on the year, the best performance through November since 1997. And going back 50 years, the S&P has always gained in December after rising 25% or more in the first 11 months. That's a technical way of saying the rally could continue. Well, joining us more for his take is David Waddell, CEO and Chief Investment Strategist at Waddell Associates. He joins us now in the studio. David, good to see you. Thanks for joining.
Good morning. Nice to be here.
Is that the deal? Like, hey, we're up, just to keep buying it. Why not?
I think the number of occurrences in that sample space was rather small, but we'll go with it.
Okay.
So I think the Santa Claus rally can continue. And, you know, what's amazing is that earnings are accelerating from here, right? So as we look out over the next 24 months, earnings grow 15% next year, maybe 15% the following year. And so with that as a backdrop, and by the way, here's a nice stat, in years where there's not a recession, markets are higher 86% of the time. So it bodes well for next year, and I think people are squaring that going into the end of this year.
We're almost a month past the election. When you woke up the day after the election, did you and your team, rethink maybe your outlook for asset allocation or maybe how you think about investing? Did the change in administration and the Republican-controlled Congress, did that change how you looked at things?
It's a great question. So to a certain extent, we were also already anticipating a move down the cap spectrum. You know, I don't think the Mag 7 go to the Lag 7, but other people should participate, and they have in the second half of the year. So we'd already sort of moved down the cap spectrum, which is part of the Trump trade. The part I hadn't really anticipated was how strong the currency reaction was going to be. So our offshore holdings currently are unhedged. That's up for discussion now in terms of, because the move in the currency has been dramatic. And that may be the big story for next year, less so interest rates, since it appears that the markets like our new Treasury nominee. But that's up for discussion on the investment committee, is whether to hedge currency or not.
Well, that's actually quite interesting, because President-elect Donald Trump has made no bones about the fact that he wants a weaker dollar, but then the threat over the weekend to the BRICS nations about you still have to use the dollar, and we know that tariffs are coming. How does that square itself?
I don't know, and I keep going through that gymnastics in my head, but I'll tell you the most interesting thing to me is U.S. imports are $4 trillion. If Trump slaps 10% tariff on that, you know, it's $400 billion in potential tax revenue. Now, my economics textbook says, well, that just means that Ford producers are just going to raise their prices 10%. Well, the dollar's appreciated 8% since the end of September, which almost negates that in the marketplace. So I think the interplay between the tariffs and the movement in the currency may be the most interesting thing going into next year. And again, that may just be, you know, statecraft and jawboning and not really policy, but more negotiating positions. We won't know. But I think the currency is the most interesting.
U.S. versus non-U.S., how do you guys position that, generally speaking?
Well, so we benchmark against the all world, the ACWI, and we've been tilted towards the U.S., but the valuations overseas are much more compelling. The earnings growth is okay, but Europe seems anemic and continues to struggle. I think, you know, the stock market in Germany, and if you look at earnings in Germany and the size of that economy, hadn't done anything in the past few years. And so it makes it somewhat challenging to defend that position. But right now, at the moment, with policy being so uncertain, I don't think it's time to be making large transitions either onshore or offshore. But obviously the bias is towards the U.S. right now, and that's reflected in the currency markets.
So what do you think it's going to take for you guys to make a decision whether to hedge your ex-U.S. exposure? Like, what's going to tip the scales for you guys?
I would never fully hedge it, probably, because, again, currency markets are fickle and challenging, and things can change a lot with policy proclamations. Right now, we're fully unhedged. In terms of what portion of that to hedge, I don't know. That'd be a position-by-position decision.
Okay.
It seems like ever since I've been in this marketplace, June 16th, 1986, by the way, growth has been the story.
Yeah.
How about if you're a value investor? What do you do here? How does this new world that we're kind of entering, how does that impact?
I've been making the standard deviation argument for a while, which is that performance and valuations have reached extreme levels. That is true. But if you look at this year, utilities have outperformed technology, right? Financials have outperformed, industrials have outperformed. And if you look at the trade since Trump, value's done very well. I mean, the Mag 7's done fine, but mid caps, for instance, which are more value laden, have outperformed small caps, which obviously have a lot more financials, since June 30th are up twice as much. So I think, I hate to say, we're overdue because we've been overdue for a while, but I do think the value trade has some substance to it. And if what we're trying to do is drill another 3 million barrels of oil per day, which is a ton because we're drilling, 13 and change, that's going to benefit materials companies, that's going to benefit industrials companies, and a lot of the Inflation Reduction Act infrastructure spending hasn't even come out yet. So I think industrials end up being kind of the darling. In Trump 1.0, energy actually was negative, even though the S&P 500 was up 70% over that period of time. So, I'm not sure all value sectors benefit, but I would say industrials look good. Financials can continue to look good, especially with less regulatory pressures, and materials should look good. So, and utilities, the earnings there are pretty substantial, and there's some obvious link with what's going on in AI. So it may be that value's overdue and that 2025 will be the year of value. We'll see.
We'll see, exactly. I was going to say, who doesn't like 3 million barrels of oil a day extra oil? Oil companies.
That's right. Which is why the industrials and the materials seem more attractive.
What do you do then with tech? You said, earnings outlook for technology is definitely going to be lower next year, right? But it's not nothing.
Right.
It's still going to be double digits, probably in the mid-teens. How do you invest in big tech currently?
Well, it's kind of curious, if you look at the SOX, like half
the semi-index.
Yeah, half the stocks in there are negative this year, and I think the index itself is up about 13%. So it had a great 2023. It did not really have a great 2024. But if corporate taxes are $450 billion, and Trump's going to cut them by another 33%, that's going to create a lot of ammunition for CapEx. So I don't think the tech trade is over. It's just more fun when other people participate as well. So I think everything.
So you don't have to
works.
sell tech.
No, I don't think you sell tech. But I do think you start moving towards more mid-cap, small-cap exposures. In fact, since Trump, I think, was elected, the number one performing factor was small cap growth. So mid cap tech, small cap tech, a lot of CapEx. I see all of that as bullish.
Bond market, 2-year Treasury 4.2%, or do I take some credit risk here?
Here's the thing. So during Trump 1.0, nominal GDP was 4.8%. Real GDP grew 2.8%. Inflation was 2.1%. So we're sitting on the 10-year, which is where the equity market really prices, at 4.22 or something, call it, whatever it says. That means that we're priced appropriately from a PE perspective for the stock market. So I think things have got it right. What'll be curious is when the Fed comes out on the 18th, they'll release their summary of economic projections, and we'll see where they think the neutral is. Obviously the number of rate cuts has come off the table to about 2.5 over the next 12 months. And so there's a lot more tensile strength in the economy than people thought, and we'll get, I guess, the ISMs this morning. I'm looking forward to that.
Yeah, they were actually pretty good.
Yeah, did manufacturing go positive?
So the new orders went into expansion territory for the first time in 8 months. The other parts of the indices didn't, but it was close.
Yeah.
And we heard the inventory started to rise again, so really gearing up for a business cycle in 2025.
Yeah, and where was service? I guess we'll get services tomorrow.
Later, yeah.
So if manufacturing turns the corner and starts being expansive, then where should the neutral rate be? So I think that's the big question mark. But I think we're back to 2.5 rate cuts. Although, I'd love a Christmas cut on the 18th.
Right. You think we're going to get that? Or
I mean, they broadcast. I don't know where the CME tool is. It was at 66% when I looked over the weekend.
It looks like we are priced in for at least one. But
good.
Yeah.
That'd be great.
Okay, you like that. And ISM Services is coming up on Wednesday, so we'll break that down to you as well.
David, you're based in Memphis, Tennessee, right?
Memphis and Nashville. Yeah.
Memphis. Talk to us about Memphis. I haven't been to Memphis. I don't think I've been to Memphis. Talk to us about the economy down there. What drives Memphis?
Well, right now, Elon Musk, because he just decided to build his AI data center in Memphis, Tennessee.
Oh,
yes,
excellent.
Exactly, and doubled the capacity immediately. And they continue to raise money for XAI, which means more capital expenditures. So there's a lot of industrial expansion going on right now because we have a great power grid. We've got a great logistics network. Our anchor tenant is FedEx, which is the global nervous system from a trade perspective. And so I would say Memphis is a value stock, right? With an opportunity to buy it. You run 3 hours up the road. Nashville is a growth stock, and headquarters just continue to move there almost every single day. So it's an age of renaissance in the state of Tennessee right now.
I tell you, you read about it. I'm just looking around here. Memphis, Nashville, you hear so much about Tennessee. It seems like every car company. What's it about Tennessee?
Well, Corker was good at that too. Yeah. So we had great political leadership. Bredesen was amazing. Corker was amazing. And Nashville has been very aligned on a growth agenda politically, philanthropically, in the private sector, obviously. And so it's just, it's a great time to be in Tennessee.
And Nashville's become which I don't know why, the bachelorette party capital of the world, surpassing Vegas.
The only time I was in Nashville was with you with radio, but I was so sick I didn't leave the hotel the whole time for 3 days. So
it's good times. Come back.
So that hotel was nice.
It's a great time.
They had nice Starbucks. All right, we appreciate your time. Thank you so much, David. David Waddell, CEO and Chief Investment Strategist at Waddell Associates.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, the political news today is coming out of France. The far-right National Party of Marine Le Pen will back a motion to topple the French government after Prime Minister Michel Barnier failed to agree to all of its demands on next year's budget. Let's get the latest reporting there with Ben Sills, Bloomberg Managing Editor for European Economy and Government. Ben, can you educate us as to what's happening in Paris right now?
Yeah, well, it's difficult to keep up, to be honest. We've got the headlines breaking on the terminal right now, just in the last few minutes. As you say, the far-right party of Marine Le Pen has come out and announced that they are going to vote to bring down the current administration. It's been a really dramatic few days. The Barnier government has been walking on thin ice ever since it was formed in September. Their lack of a majority in the parliament meant that Marine Le Pen effectively had the power of life and death over that government. Barnier has been desperately trying to get his budget through. Feels like every other day for the last week or so he's been caving in to one demand or another. He's now, by my reckoning, given Le Pen 3 or 4 of the main demands that she wanted. She's still not happy, and so she's decided to pull the plug on the government.
Right, and by forcing it through, therefore, thus, a vote of no confidence can be called. Within the market, we are looking at a weaker euro. There's also been a lot of talk about how the difference between yields in Germany and yields in France, well, France and Germany, has blown out, and that it's at the level that we haven't seen since the European sovereign debt crisis back in 2012.
Wow.
It's an easy comparison to make, but it's very different when you look kind of under the hood at that.
Yeah, absolutely. So, I mean, the threshold that we were struck by last week was when the French bond spread actually went wider than the Greek bond spread. You know, those of us who were around 10 or 15 years ago when the sovereign crisis blew up, got used to tracking the Greek spread, but we never really thought that France would be in the same boat.
So where do we go from here? Where did the French go from here, and kind of what's the time frame here?
Yeah, that's a good question. I mean, I think that in terms of the kind of the next steps, we'll be looking for the no confidence vote to happen in the next couple of days. We would expect that to go through. That doesn't really resolve anything, though, because under the French constitutional rules, they can't hold another election until next July, I think. And so there's no way to put this to the vote to get a new kind of parliament there. So Macron is going to have the same complicated, divided legislature to work with. The parties are going to have to try and come up with a new agreement for governing. But I think everyone's going to be looking at Le Pen. She's setting the agenda here. She's the one who has decided to force the issue, and so there will be a certain onus on her to make the first move when we come out the other side of this crisis.
And one of the triggers for this was, of course, the snap election that sort of set up the government like this in the first place. Are we at risk of having that happen again?
Yeah, I think that, this is something that's been building for a long, long time in France. Le Pen has been a fixture on the political scene there for, more than a decade. She had her first presidential run against Macron in 2017. And so the French establishment has been coming up with a series of kind of increasingly creative ways to keep her out. But her stock is higher than it's ever been before at the moment, and you can see that by the way she's leveraging her power this week. The end game really centers on the 2027 presidential election. That's when Le Pen is really aiming to finally take power in France. The question is, does Macron hold out till then? There has been speculation in France that he might quit, but he's insisted he's not going to do that. So that means we're kind of in this sort of slight limbo situation where no one can really govern, but they can't force an election.
Ben, thank you so much for that reporting. Appreciate it. Ben Sills, Managing Editor of Bloomberg News. He is coming in from our Berlin, Germany studio on the latest news coming out of France. Some political instability right there. We're seeing that in the euro.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, and we're streaming live on YouTube as well. So head over to YouTube.com and search Bloomberg Podcast, and that's where you will find us. Let's check in with our next guest here, because what a lot of folks are trying to do is figure out how to reposition their investment outlook, their portfolio for a second term of President-elect Trump. Any changes that need to be made, people are trying to think about those right now. Peter Andersen is one of those folks, founder and chief investment officer for Andersen Capital Management, joining us from Boston, Mass. Via Zoom. So, Peter, we're almost a month removed from the election. We now have a Republican White House and a Republican Senate and Congress, by thin margins, yes, but still there. Given that backdrop, have you and your team made any changes to your outlook for investing?
Normally, this would be kind of a textbook exercise, but with the nature of President Trump, it's very, very difficult to make any kind of projections. And he's thrown several monkey wrenches into the works now. There's certainly the tariff situation has everybody running and scrambling to analyze how this is going to work out. So I would say the past playbooks, you really have to throw them out, and you have to look at something totally different, which is the dynamics of tariffs. How is that going to influence potentially higher interest rates? items like that. So we are looking, but I will tell you, it's almost a fool's errand to try to work through all that and come out on the other end of that analysis with a highly confident outlook based on what the president is going to do.
So, all right, there's a high level of uncertainty out there. We've heard that from a lot of market participants as well. Given that, where are you guys today? Stocks, bonds, value, growth? How do you position right now?
Well, I just run a single strategy, and it's a growth strategy, equities. It's an all-cap strategy. So what we're doing is we're looking at the current holdings, and we're asking ourselves, how vulnerable are they to policy changes? And if there are stocks, in our opinion, that are more vulnerable to the uncertainties of those policy changes, we would probably look at selling. However, we've reviewed the entire portfolio, and in our opinion, all these stocks that we hold, which are under 15, in fact, are fairly invulnerable to tariffs, to interest rate changes, things of that matter.
How much of that is going to be, say, AI and big cap tech?
A lot of big cap tech. Also, I was a big enthusiast of artificial intelligence, namely NVIDIA and Supermicro and some of the others. But we're thinking now that the enthusiasm is a little bit overspent, and anticipations of how much AI is going to actually accomplish and contribute to the bottom line, we think is vastly, vastly exaggerated. And so we have trimmed those exposures dramatically coming into the next year.
Peter, how many stocks do you own in your portfolio today, roughly? And is that in line or a little bit different than past strategies?
Well, actually, exactly 13 stocks.
Wow.
So it's fairly concentrated. I don't think you'll find another manager out there that runs a concentrated portfolio of that few numbers of stocks. So you can imagine that it takes great confidence in the holdings and understanding each one. And certainly now with the change in administration, it actually puts more of an emphasis on that and to try to play out what we think is going to happen. So for instance, you mentioned artificial intelligence, but cybersecurity is a major exposure in the portfolio. And we think that regardless of who is in the administration or where interest rates are going, or if we have 100% tariffs, as have been mentioned recently in certain countries, we don't think cybersecurity would be impacted by that. It just makes common sense to us.
13 stocks. What's your average holding period? I would think once a stock gets in your portfolio, it's not going anywhere.
That is true. You know, the turnover is under 30%, averaging over the past 10 years. And we really do spend a great deal of time looking at these stocks and, we sometimes get criticism, well, it's so concentrated. What about your competitors? Your competitors own anywhere from, let's say, 50 to 100 stocks. And we challenge them on understanding those holdings in as much detail as, say, a portfolio of under 20 stocks.
So when you talk about the AI trade, like when you said that you think that it's an over-promising, well, I'm paraphrasing here, but the expectations are just too high. What do you mean by that? Is it just that it's not going to be this big revolutionary thing, or that money eventually will stop being spent on it? Can you dissect that a little bit more for me?
Of course, and thank you for asking, because I really do think this is a neglected point that investors really have to spend some time on. So I think investors have gotten a little bit over their skis in thinking that AI is going to be the cure-all of everything. And one thing I can just mention to you is if they think that it's going to emulate human thought, the brain is about the size of two fists. Look at the real estate of ChatGPT, for instance. I mean, it's enormous. And now we're thinking of dedicating nuclear power plants to powering these things when the human brain works on a refrigerator light bulb wattage, under 10 watts. So we're going down the wrong path, we think, in terms of formulating artificial intelligence and making it human-like. We think that that's at least 10 or 15 Nobel Prizes away, and investors have not caught on to that concept yet, nor have certain CEOs. They continue to spend enormous amounts of money, and when you ask them what the rationale is, they say, well, because our competitors are spending just as much money.
All right, Peter, thank you so much for joining us. Always a pleasure chatting with you. Peter Andersen, he's a founder and Chief Investment Officer of Andersen Capital Management up there in the Boston area.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alex Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. Now, every Monday around this time, we also tap our great resources from Bloomberg BNEF, formerly known as Bloomberg New Energy Finance. They give great industry research on power, transport, industry, buildings, ag sectors, as well as how to navigate change within this energy transition, and they look at it from a business and finance lens. So joining us now is Enrique Gonzalez, Bloomberg BNEF, head of U.S. gas research, and we're going to be talking about gas. Now, what's interesting about gas is that we make a lot of some hay, about U.S. oil exports, but in actuality, it's U.S. gas exports in the form of LNG that is a huge transformational part of the energy story here in the U.S. Where do we stand now? And where do you think we stand once President Trump takes office?
Yeah, so as mentioned, the U.S. is the largest exporter of LNG in the world. And in the short term, we have a considerable amount of new capacity coming online. And that was bound to happen regardless of whether we had Trump or Kamala in office. But yeah, we have Plaquemines and the Corpus Christi Stage 3 expansions coming in this December or early next year, and then the Golden Pass LNG terminal as well. So giving us more than 7 BCFD, 7 billion cubic feet per day of new export capacity out of the U.S. So further consolidating that role. And then where the change could be more significant is in the medium term, with the terminals coming later this decade. And especially with these discussions of Trump lifting the DOE non-free trade agreement permit pause, because this is a key permit that the terminals need to be able to reach their final investment decision. And there's a few high-profile projects there, such as the CP2 expansion from Venture Global. And then we also have a Sabine Pass Corpus Christi expansion alongside other projects that are targeted for them.
So basically, if you're not exporting LNG to a free trade agreement country, then you're no longer allowed to do it. But many said that was like an export thing that they were doing that really wasn't going to hold, that it was just an election thing. So that's what we're referring to. So that would really help get a lot more investment in there.
Is the expectation in your world of natural gas that a Trump administration combined with a Republican-controlled Congress, this is going to be the time to get stuff done, whether it's a pipeline or a refinery or anything?
Going back to the idea of the LNG terminals, it's definitely, you have more support to get these projects done. I think moving to the idea of pipelines, interstate pipelines, that's there needs to be more change. It's a bigger conversation, but it is there's definitely more momentum than we would have otherwise had.
So to that point, and it's a good one that you make, because a lot of the gas that we have is in Appalachia, and it's really hard to get that gas out. It's in the Northeast. You don't have a lot of takeaway capacity, and you do get a ton of gas from also shale production, so within New Mexico as well as Texas. So there is that. What do you think we're going to be able to do in terms of getting pipelines in to get gas out of Appalachia?
Yeah, so I would say that's not my subject matter expertise, the policy behind the pipelines, but I think there is space to have more discussions about what can be done to get some more gas from. But
if we don't, do we wind up getting a glut at some point of gas because there's just too much and we can't get it out, therefore gas prices here in the U.S. kind of really sink?
Yeah, and when we've already seen this happen, especially this early November when the weather was pretty warm, we've seen, Appalachia can't really send more gas out. There's not internal demand in the basin. And then we've seen producers actually curtail production because the prices have dropped below the the level they need to continue producing even from existing wells, and they're well below the break-evens in some cases for new wells. So we've already seen that have an impact in production in Appalachia. And as well in other parts of the country, you have the Haynesville as well, that's closer to the Gulf, and where a lot of the rhetoric is that the production to meet the demand from these new LNG terminals is going to come from there due to the location, but they do have higher break-evens and higher costs than in the Northeast.
Coal. What's going on with coal, and what do you expect under a Trump administration to happen to the coal industry in this country?
Yes, so there's been a lot of discussion now about potentially rolling back some rules from the EPA, or just having or being easier on pollution from coal. I've seen, I think it was Duke Energy as well, discuss the possibility of keeping some of their coal plants operating for longer. So that is a possibility, and what it could mean for gas and for power sector gas consumption could be pretty interesting, because over the last 10 years, one of the main roles of gas in the power sector has also been replacing, this retiring coal plants, which has been a benefit in the sense that we've seen lower emissions as well. But this could be more difficult if the coal plants stay operating longer. You might not see gas taking over in the same way it had been.
That's interesting. That would remove this very mechanical market function, basically, for gas and coal. Is the coal, is it green coal? Is it nice coal that we can all get behind, or is it still dirty coal that eventually is just going to have to be phased out?
Yeah, and there's a lot of discussion as well about integrating carbon capture for coal, try to make it cleaner. But yeah, the economics are difficult. And especially in the short term, we probably won't see a lot of that happen. So it could result in emissions even increasing.
Is there the expectation under Trump administration that just the whole move to renewables will slow down, and maybe slow down materially, or is it just too much momentum?
Definitely parts, for example, of the Inflation Reduction Act are repealed, or there's changes in that sense. We could see slower deployment of renewables. My colleagues in BNEF, in our clean energy teams, look in a lot of detail into this. But yeah, this could lead to an interesting dynamic where you have less coal retirements, but maybe you have a slower deployment of renewables. Where gas maybe doesn't grow because there's less coal, but takes over some of this generation that would be needed that would otherwise come from renewables. So I think there's a very interesting analysis and a conversation to have about how this gap is going to look.
All right, Enrique, thanks a lot. Enrique Gonzalez, Bloomberg BNEF, head of U.S. Gas Research. Thank you so very much.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.